You're the owner of a small business, which means you're also the tech guy, and HR, and personal assistant, and head honcho, and intern. You could use another pair of hands, like the experts you'll find at Verizon Small Business Days, April 21st through 27th. Get a free tech check, special deals, and more. Call 1-800-483-4428 or visit verizon.com/smallbusiness to book your appointment. Verizon Business.
Reality radio for a really great future. We're talking real money.
Oh my gosh. What are people thinking? Tom, I'm looking at a chart of the stock market, the S&P 500. Oh my gosh, recently, did you know that? And the Dow have been at all-time highs recently? Oh my gosh, I don't think I can invest when stocks are at all-time highs. The market's up. I should wait for it to go down, shouldn't I?
Absolutely right, Don. Thank you for bringing that up, because market timing is the key to a successful retirement portfolio. Anybody knows that. It's easy to see the top right here. You're going to sell. If you're in, you're going to wait to get in if you're on the sideline. That's a no-brainer. Thank you for raising that.
All right, good. Man, do you see how much better I feel just from that now? Oh, wait, Tom, here's the other part.
Out of your face.
Here's the other part, though. When do I get back in?
Well, they don't ring a bell and no one calls you, and I'm pretty sure there's no delivery from Amazon that alerts you to the fact that you need to get back in the market. Yeah, we were having a little fun there because this is a question that comes up regularly. Let me take a guess.
Yeah.
Especially when markets are high.
Yeah.
People call and say, well, I wouldn't invest now because market's way up there. I'm going to wait till it goes down, Tom. If anybody knows that, because the suckers come in at the end. Well, here's the thing, okay? Let's just give you a couple of numbers to cogitate about. This is data compiled by Dimensional Funds, organization that we trust. From 1926 through 2019, the average annualized compound returns for 1, 3, and 5-year periods after 1, 3, and 5-year periods after new record highs. You ready?
Yeah. Please give me numbers.
The 1, 13.9. The 3, 10.5. And the 5, 9.9. Isn't 9.9 about what the market returns over the long haul?
It's almost exactly what it returns over the long haul.
Yeah. So, I mean, people get caught up in this. Again, I think in my heart of hearts, because it's way overreported, because stock prices are everywhere. They're on your phone. They're on your radio. They're on your they're everywhere. You can't avoid them. And we have a tendency to believe that there's a trend here. The market's gone up. It's got to go down. That's the one I get from people a lot, Don. Well, you wouldn't want to get in now because it's gone straight up. It has to turn and go back down. And you already know this. We try to tell people that your stock to bond ratio should be about you, not about the markets.
Oh, I thought he was going to give a number for the first time. No, it's about you.
I know. It's how much you're trying to make, how much volatility you're willing to accept, and how soon until you need the money. If you need the money inside 5 years, I'm not sure you should be running out and buying stocks at all. Nothing. But you got to know that. You got to know your risk tolerance, right? That's why we give you the risk quiz absolutely free. And then how long until you need that money. And then after you know all those things, here's the good news. You can listen to the podcast. It's fun. You can tune into our radio show. It could be hilarious. But you're not reliant day to day on what the market prices are to determine what you're going to do. You're going to tune out all that financial noise that is out there 24/7 today. So, no, I'm not concerned with the market at record highs. By the way, I'm not planning on touching my money for another 7 or 8 years. And if the money you need to touch, then you have money in bonds, if you're already living off it, that could supply that should the market head the other direction.
And I have sitting in front of me a chart of what we refer to as the market, but it really isn't. The Standard & Poor's 500 going back to the 70s. And I'm looking at this chart, and I see little bumps where it's high, and it goes down a little. But the funny thing is that they're little bumps. And if you were to just stretch all the little bumps out of this line, it would point pretty much right straight up, because that's what the market's done. I mean, I see it went down in 2000, but then I see it came back up in a few years later and beat those highs. Then I see it went down in 2008, and then I see it came right back up and beat those previous highs. And then I see it went down a little. And do you remember it going down a little in 2015?
Not much.
It did. It went down a little in 2015.
I remember 2018.
And then it went way back up, and then 2018 went down a little, and it went way back up. Then, 2020 went down a bunch.
It did.
Came
yes,
right
last
back
spring,
up.
a year ago. Mm-hmm.
So let's say you said, oh, man, this market's at all-time highs on February 1st, 2020. You went, oh, yeah, I'm getting out of this market. And you did. You would have felt pretty good getting out at 3,200 on the S&P 500 when it declined to 2,800. You would have felt really good for about a month, maybe two. Then
and
by summer,
go ahead.
By summer,
yes,
it's back in over 3,000 again. Remember, it's at 3,300 when you sold, and now it's at 3,900. Whoa! Did somebody ring? Do you remember a bell in April to get back in?
I never heard it. I heard the air raid siren, but never the bell. I mean, here's what two things we know about market timing. All the market timers, you have ended up with less money. And here's the one we learned this year from the new study. You've actually increased the volatility in your portfolio. So what you accomplished was the exact thing you
less
didn't
money, more risk.
Yeah, you didn't want. I don't want to. I feel less. All you've done is do yourself in. So you should know what you're trying to achieve, and you should know how much volatility you're willing to accept. After that, you're invested. Good markets, bad markets. The only time that would all change would be a life change, something in your life that changes that requires you to reduce maybe the stocks or add whatever it is. But the rest of it, as I said, is purely noise with a capital N.
Call us with your questions if you have them. I'm sure you have some. 855-935-TALK, 24 hours a day, 7 days a week. Just leave them on the electronic system, and we will answer those on a future podcast. There's another way to do it, too, though. You can type them in, going to talkingrealmoney.com, hitting the contact form, or you can actually hit the mic button, use your computer mic. This is new technology, pretty fancy. You could even use it on your phone. You could do it on your phone, just with your mic. You don't even have to call. And you could do just like this.
Hi, guys. My name is Ben. My wife and I are both about 40 years old. I have a 401k that I contribute to the max to. My wife has a 403b, but we don't contribute at all to that because it has terrible options, no matching. They have annuities and things like that, and so we don't contribute anything to that. We both max out our Roth IRAs. And my question is, in the next couple of years, we might be making more collectively that we won't be able to contribute to Roth IRAs anymore. Is there another option, or is taxable savings kind of the next best option? Second question is, I've heard a little bit about a backdoor Roth. Just wondering how that works once we get to that point, if that's an option for us or not. We both have a couple past 401ks from other employers that we've converted to individual retirement accounts, traditional ones. So I'm not sure how that affects the overall plan. Thanks.
Well, let me just say something before Tom gets to answering the questions. Again, yours is a perfect example. I'm going to guess your wife is probably a teacher. She may be in the healthcare industry. That's where you get 403Bs. But the education industry is notorious for being under the influence of insurance companies and allowing their employees to literally be financially shafted by a bunch of robber barons at big insurance companies. And in many cases, the unions are lining their pockets from these insurance companies. The administrators are. It is a corrupt organization, in my opinion, that only offers their employees annuities in a retirement plan. I really do mean the word corrupt. Maybe incompetent, but probably not, because they're supposed to be smart people. There.
And it's about to get worse, as you know, because annuities are going to become more prevalent in retirement plans, make it easier for the people that run them to put them in there. That's a separate show, another issue, et cetera, et cetera.
Just makes me mad.
to Ben for a moment. The backdoor Roth is probably not an option here because if you have other IRAs and you tried to set up a new IRA to move the money backdoor, you're going to have to move an apportionate an amount of those other IRAs too and pay the tax on it. So unless you have money sitting around to pay the tax, that probably doesn't make sense, but a good advisor could certainly help you on that. Number two, there's nothing wrong with having money in the pre-tax, your retirement account, and then having a regular taxable account. In fact, there's a lot of good about that. You could invest it to offset the asset classes you hold in your 401k. And for your wife, since she has a crummy plan, you could just build a portfolio there that has all that in mind so it all fits together. There's all kinds of great options out there, whether it's exchange-traded funds or mutual funds. We give you portfolios on our website. A lot of other people like Paul Merriman that we trust. So there's great guidance to put together what I would call taxable or sort of post-tax portfolio, but it appears that's the likely situation you find yourself in.
And this is something a lot of people aren't aware of, there are tax-managed mutual funds where the mutual fund company, and Vanguard has them, many, many others, where they actively avoid taxable situations or they actively offset gains with losses so that you don't get realized capital gains or high dividends. They avoid high dividends, things like that. They go out of their way to try to reduce the taxable events that occur, in essence, giving you a form of tax deferral in that your only event. In fact, in many cases, it may be better than tax deferral, because your taxable event when you sell a growth-oriented vehicle, one that has appreciated in value and not distributed income, is at a capital gains rate, which today is lower than the income rate.
And by the way, exchange-traded funds are also very tax efficient due to the manner they're built. You have very little sort of capital gains from those as well. There's several families we like, among them Avantis. You could go use theirs. You could go use Vanguard's. That would give you some tax efficiency as well. But I think that's probably the next step for you, Ben. Sounds like you're a great saver. You're paying attention to all this. Kudos for not taking your wife's money and putting into expensive and lousy products, which is, as Don said, it's truly a continued outrage in our industry.
It definitely is. And by the way, this is from many, many years ago. I had a listener in Albuquerque, New Mexico, who believed at the time and was told at the time that the only options in the Albuquerque school district were annuities. He got together with a group of teachers. They created a petition and petitioned to get an advisor in there who could offer them Vanguard funds at the time. And they successfully lobbied the school board and the trustees of the 403B to bring in Vanguard, which they started using and have used for years.
That's a great story. By the way, here's another great story about Albuquerque. Did you know that the Confederate flag once flew over Albuquerque, New Mexico?
I did. There was a battle there. Yeah.
Oh.
Yeah.
Yeah, okay, you did know. See,
I did know.
I didn't know. I'm just reading the book right now. Wow, I didn't know that.
I'm a Colorado boy. We didn't have a lot of Civil War battles in that area.
No,
so
the Coloradans came down and helped the Union throw the Confederacy out of
the Battle
New Mexico.
of
It starts with a V, I want to say.
Something
anyway.
Pass, yeah.
Yeah. So anyway,
I can't remember the name.
I didn't know that about Albuquerque until very recently. So
yeah, for sure.
Interesting history. That's a great story. And by the way, that's another thing that people should always do in their plan is if it's crummy, you got to complain to the plan sponsor. People are more sensitive about all this today than they ever have been because there's a lot more lawsuits in 401k plans. So they're likely to say, okay, we'll do this. We'll give you some options that are decent. I think it's a great idea, and I think people should stand up for themselves in retirement plans, definitely.
Oh, and I have another Civil War story for you. Ready, real quick?
Oh, okay, please.
All right, 1860. Did you know that in 1860, Congress began to create, and then it was voted down, and some map makers actually made maps with this, a different structure for New Mexico, the New Mexico Territory, and the Arizona Territory.
I think that's in the book I'm reading right now. It has a weird shape to it. Yeah.
Yeah, that Arizona
it's kind of a western.
Yeah, one was up at the top and it went between Texas and California.
Yeah.
And the other, they were both horizontal so that one would be slave and one would be free.
Exactly. Well, you know that as the map guy. We
I
expect
had a
that
map
from you,
yeah.
and nothing less. Yeah.
All right. Hey, all. Thanks for being a part of this. Remember, you can call us at 855-935-TALK or send your questions in, type them in, or speak them at talkingrealmoney.com. Please tell people about the podcast because we want more people to listen. We really do. And you're the one who can really help make that happen. Also, if you like what you hear, leave a review at Apple Podcasts. Thank you for listening. That's Tom Cock. I'm Don McDonald, and we just sit around here talking real money.
Talking Real Money. We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit talkingrealmoney.com for more information and disclosures. That should keep the lawyers happy.